Can we wait for 5 more minutes and then?
Yeah, sure.
We just give 3 minutes, then we'll start.
Yeah, sure.
So then shall we start?
We'll give a couple more minutes. Good morning, participants. We'll start in 2 minutes, just giving some Saturday morning allowance for participants to key in. Please bear with us. Sorry, sir. Start, person. Very good morning to all. Thank you very much for sparing your Saturday morning. And on behalf of FIFA SRC, my name is Sudarshan, and I'm extremely delighted to invite you all for this webinar. For those of the regular participants who have noticed, we, as part of FIFA India from the Southern Region chapter, post we moved into the webinar mode, we've been largely trying to address international tax law from a global perspective. So what we mean by global perspective, it is trying to ascertain how the treaty interpretation, how the treaty law works in other countries, and see if we can take or mirror some of it, the reflections from an India standpoint, especially the tax treaty language being pretty common across all the treaties, and also try to, in the process, understand how the domestic law works in those countries. So that's how FIFA SRC have been innovating, because there are a lot of other programs that's happening that is focusing on the key nuances on the international tax front from an India standpoint. So therefore, we thought let's have a differentiation to it and try to focus from the other country perspective and see if we can do some mirroring or introspection, which would help us to understand the law better, the tax treaty law better. So on that line, we earlier did during the first, second waves in terms of looking at Singapore on a more intricate basis. UK was our last program, and then we did sessions covering largely on the Southeast Asia. So on that aspect, obviously the next destination we preferred was Australia for various factors. One, Australia is both an exporter as well as equally a net importer as well. So more or less something where India is slowly inching towards, and being an OECD member. And there are quite a lot of other aspects from a jurisprudence standpoint. Some of their judgments have been landmark, be it the Satyam cases, which we're all familiar with, or even the resource fund management. And recently, the Supreme Court's Catherine ID case, which talk about tiebreaker and non-discrimination, which will have an impact across the global tax jurisprudence. Not only on that aspect, with interpretation becoming very significant, even from an India standpoint, thanks to the Supreme Court's judgment and engineering analysis, where how do we rely on OECD commentary, what is the significance of it, and then the recent MFN saga that's happening in terms of how do we look at notifications, common interpretation. So I thought, we at TIFA thought it'll be very imperative to look at from Australia perspective. Again, having said that, Australia has been pioneer in terms of coming out with guidances to trying to provide clarity to its taxpayers. The ATO guidance is something which we have always looked into, the ATO rulings, and very interestingly, how they go about in terms of treating the so-called Australian speciality of source rules, which will be covered upon. So having on the tax treaty part is one aspect, but that apart, the other reason for us looking at Australia this time was also the upcoming harvest trade agreement, which is in all likelihood between India and Australia, the comprehensive economic agreement to be finalized, in the interim agreement to be done before March. So that will be very interesting to see, especially from a services sector, considering the fact that There are a lot of services which Indian providers provide to Australia, and being the top few trading partners, so I thought that'll be very imperative as well. So with this note, I will pass it on to today's speaker, who's Ms. Sumitha Krishnan. Again, one other comfort factor when we decided this topic to go with Sumitha is well known in the Chennai circles. Prior to her stint in Australia, before she migrated to Australia, she was working with Indian law firms, especially in international tax law, and she's very well versed on the India side point as well. And she's very regular to IFA SRC Chennai. For those of you of the Chennai audience will be very familiar with Sumitha, so I don't need to give a detailed introduction. But having said that, Sumitha, post her moving to relocation to Australia, she's been part of the Australian tax dispute controversies as part of the multinational firms she's associated with. Now she's also recently moved to the International Tax Division, where she handles both disputes as well as an advisory as well. She's also a qualified solicitor, so thereby now she can solicit or advise the barristers or the attorneys there in terms of international tax cases. So we have someone who can handle, who understands in India aspect as well, and who knows a fair bit of things happening in Australia as well. So I thought it'll be a perfect concoction. So with this, I will pass it on to Sumitha. Over to you, Sumitha. Looking forward to hear from you what's happening at the Australian level in terms of nuances, how Australia looks at tax treaty, to give a ground level, a zero level perspective. Over to you.
Thanks, Sudarshan, for the intro. And as usual, I think as we were discussing, you kind of exaggerated my, the level of my acquaintances in Chennai. But then, hi all, hope you're having a good start to the weekend. Welcome to the session on tax treaty interpretation reflections from Australia. Before we move on to the topic, adding further to what Sudarshan said, I just wanted to say a little something about me. I'm a dual qualified lawyer in India and Australia. I moved to Australia in 2018, and I've been working with KPMG Australia for the past 3 years in their tax controversy dispute resolution team, and recently moved to international tax team. And before moving to Australia, I was associated with Lakshmi Kumaran Sridharan Chennai office, and my flair for technical knowledge, I think I always owe it to Lakshmi Kumaran Sridharan office. The other aspect is I definitely miss India, and with the pandemic and other things, I've not got to travel to India in the past 4 years. But the good thing about being in Australia is the multicultural environment, and of course, kangaroos and koalas. So without any much delay, I'll get into the topic. First is agenda. The agenda for today is we will be looking at the following topics for the day. Firstly, overview of the Australian tax system. We will briefly discuss on the source of Australian taxation regime. The next topic is Ato Tax Dispute Continuum. I would like to briefly touch on how the dispute resolution process works in Australia. The third topic is international tax, significant recent developments. This is basically to take you through the mindset of the Australian government and the Australian tax authorities. The fourth and fifth topic, which is decoding treaty interpretation, Australian perspective, and sword and shield analogy, are the core topics of our presentation today. And finally, I will be concluding our presentation by discussing the reasons for inconsistencies and the solutions which the Australian Federal Court judge is of the view would eliminate the difficulty in interpreting tax treaties, and discussions on the latest trends in the India and Australia relationship. And I think Sudarshan covered a bit of the India-Australia relationship already with the trade agreement getting signed. I think there are further things that are happening in the background, which I would like to share with you all as well. So you all would agree that strong basics is the key to understand any tax issue. So let us start with the basics of the source of Australian taxation law. Australia has two Assessments Act. One is the 1936 Act and another is the 1997 Act. Before I move further, I just wanted to say, this is a virtual presentation and it's going to be a bit bit of difficulty in following the presentation. So I just encourage everybody to raise any questions as you may have. In that way, it will make this whole presentation interactive rather than me just talking to the screen. So it will be good if you have any questions and raise it as and when you may have. So yeah, going back, Australia has two assessment act. One is the 1936 Act and the other is the 1997 Act. The reason why Australia has two acts is initially they had the 1936 Act, and because of various amendments, the act got bigger and bigger, and they had some crazy sections like section 159G triple ZMA, which became very difficult to read and comprehend. So the Australian government came up with the tax law rewrite program to to introduce the 1997 Act. So the provisions in the 1936 Act were rewrote into the 1997 Act, and it was made clear the Parliament intentions does not change when the rewrite happens. And the next question is, why is everything not rewritten into the 1997 Act? The simple answer is they just stopped it midway because it was very time consuming and also cost heavy. And one day, I think the Australian government is hopeful, sorry about that. Australian government is hopeful that they will rewrite the 1997 Act. They will rewrite the 1936 Act entirely into the 1997 Act. The other sources of tax law in Australia are the Taxation Administration Act, the International Agreements Act 1953, and the Ratings Act. And the Ratings Act, as you can see in the slide, there are Income Tax Dividends, Interest and Royalties Withholding Tax Act 1974, Shortfall Interest Charge Imposition Act 2005, and General Interest Charge Imposition Act. Trust me, these are just the examples. I think there are around 15 to 20 Ratings Act alone in Australia. And the reason why Australia has numerous acts, and that too, they deal with only one particular area of the tax law. Say, for example, when you take Taxation Administration Act, it is going to deal only with the administration portion of the law. And when you take the Ratings Act, as you can see here, there's a separate act for dividends, interest, and royalties, and there is a separate act for shortfall interest charge or general interest charge in this case. The reason why Australia has so many numerous acts is because the Constitution is worded in such a way that it will only allow the Imposition Act to be separate and also the other acts to be separate. And in a short while, I'll be taking you through the provisions of the Australian Constitution, and you will be able to appreciate why Australia has so many acts in place. Coming back to the sources, the Taxation Administration Act deals with the procedures for filing objections, time limitation, complaints mechanism, basically deals with every aspect of the administration of taxation law. The International Tax Agreements Act 1953 is the act through which the DTAAs are ratified into the domestic law. Lastly, the Ratings Act contains the tax charge rates, the imposition rates, etc. And as you all may know, Australian Tax Office is the principal revenue collection agency of the Australian government, and the primary role of the Commissioner of Taxation is to administer the taxation laws. And every tax ruling or amended assessment comes in the name of the Commissioner of Taxation, and that's why you can see whenever an Australian case is involved, unlike in India, it is not against the government or against the state. It is always against the Federal Commissioner of Taxation or the Commissioner of Taxation. And finally, apart from the legislations, the other sources of Australian taxation law are the ATO rulings, determinations, interpretative decisions, decision impact statements, and practice statements. So these provide guidelines as to how the commissioner actually interprets the law in Australia. And as you all know, Australia is also a common law system, and therefore case laws also acts as precedents and a guidance for the source of taxation law in Australia. All these sources as to, case laws, the commissioner's ruling, everything can be found in one place, and that is the ATO website. The next slide we are going to look at is the ATO tax dispute continuum, basically the dispute process that is involved in Australia. As already mentioned, the power to administer tax administration comes out of the Taxation Administration Act, 1953. Tax administration laws impose numerous obligations on taxpayers, requirements to lodge returns, as well as setting out the framework for issuing assessments, challenging assessments and decisions, and the application of penalties and interest. Similar to India, Australia also has self-assessment system, and the first step is to lodge the income tax return. Once the return is lodged, the process is similar to India, wherein the ATO would select cases for risk review, and the process is similar to Section 143(2) notice issued by the Indian revenue authorities. At the risk phase, ATO gathers evidence using requests for information to support its risk hypothesis. Risk review outcome determines whether an audit occurs or not. So the next phase is the audit phase when it comes to the dispute process. In this phase, the ATO gathers further evidence using RFIs to support again its risk hypothesis, conducts interviews of personnel involved in the organization to better understand why a particular position was taken. And here I would like to mention that unlike in India, the Australian litigation system uses witnesses in the tax proceedings before the court. And the evidence gathering process for the litigation phase heavily relies on the witness statements. And trust me, it's a very cumbersome process to actually have witness statements of each of the personnel, because sometimes you can't explicitly say the commercial decision behind a particular choosing whether it comes to choosing a jurisdiction or anything, and it sometimes you just can't disclose certain things. And but for the purposes of witness statements, the personnel should come clean, and they have to express the main intention behind each and every move within the organization. So now coming back to the audit phase, if applicable, general anti-avoidance rule panel occurs. If the ATO feels that there is some sort of sham or contrived arrangement that is happening within the organization or the case that the ATO has picked up, they will refer the case to the anti-avoidance panel, which is an independent panel to the ATO, and they always maintain it as an independent panel so that both are not influenced by each other. And once if there is no panel, if the case is not need to be referred to the general anti-avoidance rule panel, then the taxpayer receives ATO audit position paper, and the taxpayer is requested to respond to that. And once the taxpayer is not able to convince the ATO of their position as a response to the position paper, the ATO will provide what is known as SOAP, which is Statement of Audit Position. If a taxpayer agrees with the SOAP, if the taxpayer disagrees with the SOAP, then they may be able to go to independent review. And independent review is also similar to the GAR panel, and they also act as an independent body separate from the ATO to provide unbiased view on the transactions of the company or organization which is chosen for the review. And the next process is ATO objection and litigation phase. So once SOAP has been received and the taxpayer has decided not to go with the review, the next process is ATO objection. So the taxpayer can dispute the objection by lodging an can dispute the amended assessment by lodging an objection, and the taxpayer are also allowed to provide further evidences which can prove their case. If objection decision is unfavorable, then taxpayer can commence litigation. So again, it's kind of similar process, though they have some fancy terms. I think it's kind of similar process to what the approach is back in India. And with respect to litigation, again, if it's a fact-related matters, it will go to Administrative Appeals Tribunal, or if it is anything relating to law, it'll go to the Federal Court of Australia. And the interesting thing is, in the interim, if at any stage during the process of the dispute resolution, if the taxpayer is willing to settle the matter, the ATO will be very open to settle the matter. And they have a settlement code which actually lays down the rules that the ATO and the taxpayer must follow in their discussions. And in the recent federal budget of India, I read through that the government is making a mandate for the revenue authorities to reduce filing of cases in India, for appealing cases in India, so as to reduce the pressure on litigation system. But I think India should also have something like a settlement process, which will actually enable the tax authorities to collect at least some portion of the taxes. Like, for example, if they're going to say no, if they're going to refrain from appealing the cases, all they would be doing is losing out on the revenue that can be collected. And also, I think it will be difficult for the tax authorities to also decide which case to be, taken on appeal and which case to avoid. So in that case, I think settlement discussions at least prove helpful, because at least the tax authorities can at least achieve to collect 40% or 50% of the assessment that they are otherwise trying to achieve out of the process. And that is it with respect to the ATO tax dispute resolution process. Do anybody have any questions? I can pause and answer any questions that you may have now.
There are a couple of questions, Sumitha. One is there any equivalent, just like how we have writs in India? Could we directly go to the court and file a writ in Australia? And also, what is the typical time frame that is required to complete an assessment?
See, they do have time period to complete an assessment like in India, but the thing is, it all just doesn't happen that way. Nobody here is actually pressured on the time. So what happens is, practically speaking, so they have a time period, but then the ATO will come back and say, okay, but even ATO here is like the tax authorities in India. On the very last day of the end of your time period is when they will come to the taxpayer and say, okay, we are choosing your case for a risk review. So practically speaking, there are provisions in the Act for the ATO to request for an extension, and the taxpayer also, I wouldn't say they are obligated to, but it becomes an obligation on their part to actually accept the ATO's extension, only for the reason that they want to show to the ATO that they are willing to cooperate in the process. The taxpayers are also aware that this is, if they are not going to allow for extension, it's going to backfire on their audit process. So they just want to keep it, nice and clean. So yeah, they just accept to the ATO extension. Any other questions you have?
No, that's it. So you can move on.
Yeah. Anybody else has any questions?
So the questions will normally come either the Q&A box or in the chat. So therefore, I will read it out.
Okay.
I'm not sure if the participants can unmute themselves.
Okay. Yeah. All good then. I'll move to the next slide. So,
Sumitha, sorry if you don't mind. For those, unfortunately, we're not able to give access for you to talk. So if you can please put in your questions in the Q&A box, it'll be helpful. And I'll probably moderate or transpose the questions to Sumitha. Go ahead.
okay. Now we are slowly progressing towards the topic for the session today. The reason why I've included this slide on international tax recent development is to show or to collectively understand how advanced and how aggressive Australia is when it comes to protecting its tax base. So here, if you can see here, these are the anti-avoidance laws that are existing in Australia. GAR, as most of you may know, it's the General Anti-Avoidance Rules. MAL, which is Multinational Anti-Avoidance Law. DPT, Diverted Profit Tax. MLI is Multilateral Instruments, which is quite similar to what India has entered into. Transfer pricing amendments, CBC reporting and exchange of rulings. I think one correlation before I move on, in detail with respect to this slide, I can see India, India and Australia, the one thing in common is the transfer pricing amendments happen quite quickly, and the reception for transfer pricing amendments by the governments, I think, are pretty very good, both in India and Australia. But Australia has other laws as well, which they have implemented based on the BEPS action plan. So firstly, we will first straight jump into the GAR provisions. Australia is one of the few countries that have general anti-avoidance measures, and it was introduced in 1981. The GAR is a last resort measure used to protect the integrity of Australian taxation system. It is aimed at contrived or sham transactions, as we all know, and to ensure that those sham transactions do not receive the tax benefit that they aim for. And so since GAR was something which is like an ancient law that Australia has been having in their taxation system, in a series of cases, the courts found a taxpayer would have abandoned its commercial project altogether because it could not avoid the tax on it. So basically, there was no tax benefit. These cases showed a gap in the capacity of the GAR to address arrangements. And for this reason, in 2013, the government had to come up with an amendment for GAR provisions, which will now take into consideration those transactions which were even avoided for the purpose that, there was no tax benefit out of it. And as I already said, there's a separate tax advisory body for GAR, which is GAR panel, and they comprise of senior officers and external members. And this panel advises on the application of the GAR to particular arrangements. Next is MAL, which is Multinational Anti-Avoidance Law. And this is an extension of the GAR provisions. And this law ensures that multinational enterprises pay their fair share of tax on the profits earned in Australia. And this they do, again, this is also, based on sham and contrived arrangements to avoid, attribution of profits and things like that. But this is in specific to the attribution of profits to a permanent establishment in Australia. Say, for example, if there's a permanent establishment in Australia, but and the permanent establishment significantly performs certain activities in Australia, but the structure of the organization is arranged in such a way that the attribution of profits, say for example, the permanent establishment does A, B, C, and D kind of activities in Australia, but it is structured in such a way that it only receives remuneration for A and B and not C and D. C and D remuneration for the remuneration for the activities of C and D is transferred to some other low tax jurisdiction or anything. So the MAL is basically, basically concentrates on those transactions which attributes the profits of permanent establishments in Australia. And the law applies on certain benefits derived on or after 1st January 2016. And it basically applies to significant global entities, that is entities which have annual global income of Australian dollars 1 billion or more. The next is diverted profit tax. DPT ensures that the tax paid by the multinational enterprises properly reflects the economic substance of their activities in Australia. So again, going by the example that I gave previously, there is a permanent establishment or an entity in Australia, and in papers, it is said that the company, say for example, just resells the product within the Australian region. but does not produce any software or anything in Australia. But the real economic substance is the Australian entity contributes to the R&D portion of the activity as well, and which the Australian authorities feel the R&D, the contribution towards the R&D should also be taken into consideration when allocating profits to the Australian region. And diverted profit tax basically concentrates on the economic substance of the activities in Australia. And DPT applies to income tax year starting on or after 1st July 2017, and it imposes 40% penalty rate of tax to be paid upfront. And as with MOL, the DPT also applies to significant global entities, which are entities having global income of 1 billion or more. Next is multilateral instrument. This you may be familiar with because India has also entered into the multilateral instrument agreement based on the base erosion and profit shifting arrangements. So Australia signed the multilateral instrument on 7 June 2017, and it entered into force on 1st January 2019. The date of entry into effect for each of Australia's treaty modified by the multilateral instrument depends on the treaty partner ratifying and lodging their notification with the OECD, I think, which is same as the practice in India. And transfer pricing amendments, I'm sure everybody would be aware of country by country reporting and exchange of rulings for transparency purposes. And the other interesting thing is, which I will also be covering in much detail in the later. So they call this model tax convention commentary, OECD model tax convention and the TP guidelines as soft law. And Australia believes this soft law has to be integrated into the domestic law so that, there is a smooth, it is kind of smooth when it comes to interpretation. So Australia has specific provision, which is section 815.20, which specifically says that the OECD model convention and the TP guidelines forms part of the domestic law of Australia. And that is a kind of significant transfer pricing amendment when it comes to Australia. And lastly, it is the hybrid mismatch rule. This you all might be aware, it is based on the OECD BEPS Action Plan 2. These rules target payments made between interrelated parties and ascertain if the payment gives rise to a deduction non-inclusion or deduction outcome. If they give rise to a deduction non-inclusion or deduction outcome, then the Australian deduction for that payment would be reduced proportionately. So to make things simple, I'll just give you an example where an Australian entity makes a payment to, say, US entity. US, of course, taxes almost every income that the entity incorporated in US, receives. But then for the purposes of this example, let's assume that US is not taxing a particular payment. Take, for example, an interest payment is made from Australia and US is not taxing that particular interest payment. So this will actually give rise to deduction in Australia and non-inclusion in the USA. And this is a deduction non-inclusion outcome. So if Australia has made an interest payment of $100 and there is a non-inclusion in USA, the deduction of $100 will be nullified in Australia, and thereby the entity will not be entitled to the $100 deduction. Similarly, deduction outcome is nothing but there is a deduction in Australia and as well as deduction in the US as per our previous example. By far, I think this is one of the complex set of rules we had to deal with because there are a lot of tracing provisions. What happens in the case is, and the way Australian hybrid mismatch rule is worded, so they have direct payments rule, offshore arrangements, and targeted integrity rule. So the hybrid mismatch rules in Australia not only covers direct payments from Australian entities to the US entities or any other entities within the group. So any transaction within the group between a US entity or Canadian entity could also be eventually covered by the Australian hybrid mismatch rules. So we have to do, when it comes to a global company having 100 entities, the cumbersome process is to track each and every payment that the entity has made within its group. And so to make things even more complicated, so Australia has come up with its own hybrid mismatch rule. That is, whatever hybrid mismatch rules the BEPS action plan suggested, all that is also incorporated into the Australian hybrid mismatch rules. But apart from that, there is an additional hybrid mismatch rule which Australia has come up with, and that is called as targeted integrity rule, which is in subdivision 832J of the Income Tax Assessment Act 1997. And yeah, to make things clear, I think whatever amendments that Australia makes as a new amendment, it will all be an amendment to the 1997 Act, just for the sake of understanding. So this targeted integrity rule also forms part of the 1997 Act, and the targeted integrity rule actually tries to capture interest payments between the interrelated parties that are subject to tax at the rate of 10% or less in another jurisdiction. I'm so sorry. Yeah, so targeted integrity rule. This targets the interest payments within the group which are taxed in another jurisdiction, which is 10% or less. And as I said before, I think hybrid mismatch rules is kind of the hot topic in Australia now. And I feel it's the most complex rules of all, compared to MOL, DPT, and MLI. I'll pause for a minute and check if there are any questions, or Sudarshan, if you have any questions, I'm happy to answer.
There's a couple of questions in this segment, Sumitha.
Sure.
First, I'll go ahead and then I'll take up questions from Saurabh. There are quite a lot of anti-avoidance rules in front of us. So both my question is for Saurav's questions on that. On the first, my question is, I do believe, from my interaction with academics in Australia, correct me if my understanding is wrong, that Australia has a separate interpretation act, which shows how Commonwealth statutes should interpret, which is on a purposive basis. How does it happen? Do they, because in India, especially tax laws go on a literal basis, and of late we do also see courts giving significance to purposive interpretation. So from your experience of handling these anti-avoidance, which interpretation do they still go with, a purposive interpretation? One, I'll shoot the second question. You can take both together, which is actually piggybacking the first one. So in light of these, I don't know if I can use the term interlocked, just because the use of Pillar 2, GAR, MAL, there seems to be a lot of overlap, which is what Saurabh is alluding to. There are overlap of these hybrid laws, hybrid mismatch, GAR, MAL, DPT, and MLI, and now with Pillar 1, Pillar 2 coming up, it's going to be a hot pot. So how do you see the things? And also my question is, are these DPTs, MAL taxes are part of covered taxes for Pillar 2? Will that insulate a multinational? Can they include it? Is there any guidance on it, or are there any discussions happening? Because I try to understand from UK report that there's no specific mention, or maybe I'm missing, on whether the DPT taxes being a separate anti-avoidance, so it's not part of the covered tax for me to calculate the top up. So are there any guidance on
this? Firstly, to answer on the purposive interpretation, see, when it comes to anti-avoidance, yes, I think Australian authorities are pretty clear that they don't want to, want the entities or the organization to achieve any tax benefit out of any sham transaction that they carry out. So I think when it comes to anti-avoidance, definitely there is this purposive interpretation of, um, yeah, basically looking at what the purpose is, that is definitely there. But whether they are doing it every time, whether this purposive interpretation is also applicable in other sector of interpreting the tax legislation is something that's not very clear as of now. Because see, if you see the Satyam Computers case, for example, there's a lot of other cases as well in the in the field of shield or sword analogy. And even with respect to Satyam Computers case, I think the purpose of why preamble or why the India-Australia DTAA was first in place is not taken into consideration while actually giving the decision. So I think there in those cases, I think they are not taking into consideration the purpose of interpretation. And with respect to the second questions, there are no guidance as such now, and I think it's still in the process. We are still digesting the Pillar 2, BEPS Pillar 2 rules yet. So we have to just wait and see what the government is coming up with.
Got it, Sumitha. We can move on.
Yeah.
So there's one more question in Q&A on.
Yeah. That question I think Sumitha is going to cover, services Satyam related part. It's part of the discussion. That's the reason why I didn't spend.
Yeah.
Mr. Krishnan, Sumitha is going to address that as part of her agenda. So you'll get answers for that.
Thank you. So yeah, the next topic is decoding treaty interpretation, Australian perspective. So I can safely say that we have finally come to the topic of our discussion today. And so the first thing is, we all know Vienna Convention on Law of Treaties, Article 31 and 32. And this is the Vienna Convention on Law of Treaties is basically the source of interpretation of the international agreements entered into between countries. And I'm sure everybody is aware of Article 31 and 32, but if you would like to refresh on the rules, I will give you a minute to just refresh on the interpretation rules based on Vienna Convention on Law of Treaties. And the subsequent slides, you will realize how it's quite different to what is there in the general rule of interpretation as per the Vienna Convention on Law of Treaties. I'll pause for a minute and give you all time to read Article 31 and 32. A minute is up. Hope you all had a chance to just refresh on the rules. I'll move on to the next slide. So in this slide, we're going to look at the constitutional source of power to tax and to enter into treaties, comparing the Indian and Australian constitutional powers. So in India, as you know, it's Article 253 of the Constitution of India, which gives the power for the government to enter into tax treaties and also to legislate the law under the domestic law. And Article 265 of the Constitution says no tax shall be levied or collected except by the authority of law. In the same way, Section 5139 of the Australian Constitution Act 1901 gives the legislative powers to the Parliament to legislate on matters that are incidental powers, which also includes, ratifying the international agreements into the domestic law. And Section 55 of the Australian Constitution Act, this is the particular provision that I was referring to before as to why in Australia there are numerous acts, because laws imposing taxation, the Constitution says laws imposing taxation shall deal only with the imposition of taxation, and any provision therein dealing with any other matter shall be of no effect. And this is the reason why the Income Tax Assessment Act 1936 or Income Tax Assessment Act 1997 had to deal only with the imposition of taxation, whereas the Taxation Administration Act 1953, International Tax Agreements Act 1953, and the Rates Act 1986 all deal with specific subjects of the taxation law, and Section 55 is the reason for numerous acts in Australia. And Section 61 is the executive powers for the minister to actually enter into agreements with foreign countries. And in Australia, it is the executive council that makes the decision to enter into DTA, and the minister or delegate signs the DTA. And in the case of Minister of State for Immigration and Ethnic Affairs versus Tia, it was held that DTA does not have a force of law domestically if it is not legislated by the Parliament of Australia. And as you can see, when we compare the provisions in the Constitution of India and the Constitution of Australia, they have a similar approach towards implementing international agreements into domestic law. It's not very different to what you feel with the other countries. And now moving on to see how international treaties are implemented into the domestic law. So Section 91 and 2 of the Income Tax Act 1961 provides the source for implementation of the international agreements into the domestic law, which reads the central government may enter into an agreement with the government of any country outside India or specified territory outside India, and may by notification in the official gazette make such provisions as may be necessary for implementing the agreement. So it is by an official gazette that the international agreements are notified into the domestic law. And 92, which I think is the most crucial factor here and which is very different to how Australian provisions are worded. For just the sake of simplicity, I'm just going to read the portion highlighted in green, which is the provisions of this act, that is the Indian Income Tax Act, shall apply to the extent they are more beneficial to that assessee. So the provisions of, as we all know, the provisions of Indian Income Tax Act, always apply only when it is beneficial than the treaties that India has entered into. In the contrast, if you see Section 5(1) of the International Tax Agreements Act, as already mentioned, the source of DTA in Australia or from the International Agreements Act 1953. And that says, subject to this act, on or after the date of entry into force of a provision of an agreement mentioned below, the provision has the force of law according to its tenor. So what this provision means is that, so what, as how the treaty reads, say for example, the India-Australia DTAA, as it reads, it just becomes part of the law of Australian domestic law, and that's what it means by the provision has the force of law according to its tenor. Then we move on to Section 4(1) and 4(2). I referred to Section 5(1) before because that gives the that lays the foundation of the entire international agreement coming into as a part of the domestic Australian law. Now, Section 4(1) and 4(2) of International Agreements Act deals with how this International Agreements Act and the Indian Income Tax and the Income Tax Assessment Acts 1936 and 1997 has to be read into. So Section 4(1) says, subject to subsection 2, the Assessment Act is incorporated and shall be read as one with this act. So I repeat, Section 4(1) says the Assessment Act, which is nothing but the Income Tax Assessment Act 1936 and the Income Tax Assessment Act 1997, shall be read as one with the International Tax Agreements Act 1953. Section 4.2 says the provisions of this act have effect notwithstanding anything inconsistent with those provisions contained in the Assessment Act other than Part 4A of the Income Tax Assessment Act 1936 or in an act imposing Australian tax. So when there is an inconsistency between the International Tax Agreements Act 1953 and the Income Tax Assessment Act 1936 or 1997, then the provisions in the International Tax Agreements Act 1953 prevails. I think this the structure of the provisions is very I think is the basis to understand why Australia interprets the way it interpreted Satyam computer case. So if you all would like to read, or if I can move on, please let me know. Like if you would like to read the provisions yourself for a minute, I'm happy to allow that time. A minute is up. I'll move on to the next slide unless anybody has any questions.
Good to move on, Sumitha.
Thanks, Sudarshan. So the next thing I want to bring it to your notice is the Commissioner's view on interpretation of DTAA, which is contained in the Taxation Ruling 2001/13. So taxation rulings, as I mentioned previously, contains the Commissioner's view on interpretation, contains Commissioner's view on how a tax has to be, how a tax provision has to be implemented or who is exempted and things like that. And taxation rulings are a written binding advice provided by the commissioner, and it is binding on every taxpayer, and the taxpayers are free to follow this taxation ruling and go by this. So the commissioner's view with respect to DTAs are that DTAs have two parallel characters and operate simultaneously on two levels. They first of all represent obligations that Australia has undertaken on the international law level, and on which only the country may directly rely. Once they are implemented by legislation, they also, however, represent domestic law obligations on which individual taxpayers may rely before Australian courts. So this is nothing different to what we saw in the previous slide. That is, when the international agreements remain as an agreement, they are just the international law obligation. They are just fulfilling the international law obligations of Australia. But as soon as they are implemented into the domestic law legislation, they also become part of the domestic law legislation, is what they mean here. And the interesting part is the question on whether DTAs are a shield rather than sword for taxing rights. And again, I will just refer to the portion in green. That is where the countries could, if they wish, provide through clear words of a treaty to expand the existing areas of domestic liability. And once implemented in a way that alters the pre-existing domestic laws, this would expand the areas of domestic tax liability as compared to those existing before. This could only occur within constitutional limits, of course, and the constitutions of some countries may entirely prevent such an expansion of applicable domestic law. Before moving further, I'll just explain what the commissioner is trying to say here. Basically, all they are trying to say is treaty has an expanded scope. So treaty need not be, interpreted in a restrictive way, so as to, or in an exclusive way, so as to say the treaty only are there to relieve double taxation, but cannot create any tax. But they also accept that the expansion of treaty may not be possible when it comes to certain countries because their constitution doesn't allow so. But in Australia, it allows, and and they believe that the Australian double taxation agreements has expanded scope, which can go beyond the domestic law and beyond the treaty. And by way of an example for sword-like effect, just reading below the texts in green, some of Australia's DTAs may operate to have what amounts to some sword-like effect in practice because of the inclusion in them of a source of income article or the existence of corresponding provisions in the Agreement Act itself of the type already noted. So they say the sword-like effect is basically from the source of income article, which was also the basis of discussion in Satyam Computer's case. And so we will be dealing with source of income article in a more detailed fashion in the next slides. Unless there are any questions, I would like to move on to the next slide.
Maybe can I? What is the Australian perspective in terms of the evergreen debate on ambulatory static? How does, because I'm not sure whether it's coming out of the commissioner's ruling, but how does Australia generally look at? Do they go with the OECD in terms of ambulatory, or how does that work?
No, can you explain it further, Sudarshan?
No, in terms of interpretation of treaties, the ATO looks at a static interpretation, that is the treaties at the time it was entered, or they give it an ambulatory effect, dynamic effect in terms of looking at the time of invocation of the treaty?
No, I think Australia, see, one good thing in Australia is they always try and refresh their treaty. So it's not like, like Indian treaty, I think it was entered into in 1991, and there was a subsequent protocol, I think in 2012 or something. And they also, the thing is, they don't have treaties which are like very ancient. Like even with the UK treaty, I think initially it was entered into first in 1956, and then I think in 2013 they revamped the treaty completely and they entered into a fresh treaty, and they keep it as a project to keep updating the treaty as and when there are changes. So I don't think the question of static or ambulatory actually comes into play here, because every I think minimum 10 or 20 years is what they say, and they want to keep negotiating the treaty, and I think that's a good practice too. So
Thank you.
yeah, moving on to the next slide. So we have come finally to the source of income article in Australia's DTAA. And so Australia's DTAA basically are based on, the OECD convention, but the source of income article is something very special to the Australian treaty, is very special to the Australian treaty purposes. And so what exactly this source of income article does is, they actually deem certain income that one of the contracting states may tax under the DTA to be treated as having source there for the purposes of domestic law. And the reason why the source of income article came into place is because all they want to do is, if the DTA allows a taxation, and if there is no corresponding domestic law provision, Australia wants to make sure that there is no loophole to say that there is no corresponding domestic law provision, and therefore this is not taxable, which is exactly what happened in Satyam Computer's case. And that is the sole reason of having a source of income article in Australia's DTA. I will come to the history of the source of income article, but for time being, we will just understand that there is a source of income article in Australia's DTA, which is only peculiar to Australian tax purposes. And so and it aims to, deems income to certain incomes to have source in the domestic law provisions only when it has given rise to only when it has created a taxing rate under the DTA. So the example, I have just provided examples of how this source of income article reads. So the first thing is Australia and Switzerland DTA. So it reads income, profits or gains derived by a resident of a contracting state, which under any one or more of Articles 6 to 8 and 10 to 19 may be taxed in the other contracting state, shall, for the purposes of the law of other contracting state relating to its tax, be deemed to arise from sources in that other state. So as I said previously, all they are trying to achieve is if it is taxed under the DTA, it is also deemed to be taxed under the domestic law provisions. And the other thing is the purpose of source of income article. So the rule, see, at the end of the day, DTAs are in place only to alleviate double taxation. And in this case, the source of income article does not create any, does not go against the purpose of alleviating double taxation, or it does not try to create taxation rights in two countries. All that it does is as I said, the income will be deemed to be sourced in Australian domestic law purposes if it is taxed as per the DTAA. And even if the say, source of income article rule gives rise to a double taxation effect, I think as we have seen in the India-Australia DTA, Article 24 says that double taxation will be relieved by the country of residence in respect of tax levied by the other country in accordance with the taxing rates allocated to it through the income being treated as foreign income for credit or exemption purposes. So basically, even if source of income article is going to give rise to a double taxation effect, it can all be alleviated by the credit or exemption regime that is already present in the DTA. So I will move on to the next slide. So this case, Federal Commissioner of Taxation, which is versus Mitchum, this is the real reason why Australia has a source of income article in place. The facts, I have given it very in detail here, but just to summarize. So Robert Mitchum, he was an actor and he was a resident of US, and he had an agreement with a Swiss production house to provide consultation services. And the Swiss company entered into an agreement with Warner Bros. In California, who you all know, the animation giant production house. And so this Swiss company production house entered into an agreement with Warner Bros. In California for a photo play that was to be taken in that was to be shooted in England and also in Australia. So Warner Bros. California transferred its rights to its subsidiary, who was actually the real production house in charge for taking the photo play. And so based on this, RM was in Australia for a period of 11 weeks to do the photo play shoot for Warner Bros. London. And as part of the photo play, he also gave some advices to the services to the producer of the play as a consultant in connection with the production. And in December 1959, the Swiss company, the initial production house with which Robert Mitchum had an agreement, assigned its right to receive compensation from Warner Bros. To another production house incorporated in the US. So the US production house paid USD 50,000 in discharge of the Swiss company's obligations to Robert Mitchum. So the Australian Commissioner of the issue here is the Australian Commissioner of Taxation assessed Robert Mitchum to tax on the sum of GBP 16,675 being the gross income for the 11 weeks that Robert Mitchum worked in Australia, on the basis that because he worked in Australia, the source is in Australia, and therefore Australia gets the right to tax Robert Mitchum's portion of salary that he received during his stay in the Australia. So, and Chief Justice Barwick held that there is no just I mean the exact wording of the decision is here, but just to summarize, the Chief Justice held that there is no source here, or there is no statutory definition of source found in the Act, and therefore it cannot be said that because somebody is working within Australia, the source the source arises because of the connection in Australia. But we may all find this decision a bit outdated, because I think the international tax principles on source, nexus, etc. It is what drives the international tax law, is the basis of the international tax law. But we are talking about a case which was in 1965, which spoke about source rule. And I think international tax law was not even existing at that point in time. And this is the reason why, and because the judge said there's no statutory definition of source, so instead of trying to define the term source in domestic law, all Australia did was to include a source of income article into their DTAs, to deem that if it is taxable as per DTA, then the source as per the domestic law automatically exists. I would like to pause here to see if anybody has any questions before I move on.
No questions. But yeah, as you rightly mentioned, this Mitchum seems to, even before Article 17 came into picture. So I think the Article 17 would squarely take care even under the existing tax treaty law. But yeah.
Yeah.
So this is present in all the Australian tax treaties.
Yeah, source. I'm going to cover that in next slide. Okay. Yeah. Yeah, so going by Sudarshan's question, so is this source of income article covered, is the article inevitable in every treaty that Australia enters into? Interestingly, I could see, I just did a quick search for the purposes of this presentation. I could see Australia does not have this particular source of income article with respect to China, Israel, Singapore, Russia. And the very interesting aspect is Israel's treaty was entered into very recently, that is in 2019. And in 2019, they have not entered into a source of income article with Israel. And to address the concerns, the Australian government announced in 2019-20. So to avoid all this trouble of negotiating treaty and having a particular article in the DTAs, they have come up with a different game plan to actually implement a new section or introduce a new section 764(10) into the Income Tax Assessment Act 1997. Which now provides that income, profits or gains derived by a person are taken to be derived from an Australian source if the person is a resident of a foreign country or foreign territory for the purposes of an international tax agreement. And the effect of the agreement is that the income, profits or gains may be taxed in Australia. So all this 764(10) is trying to do is give the domestic law stamp for the source of income article rule rather than in the DTA. And yes, I agree, this is a unilateral domestic measure by the Australian government to protect its tax base, but this is justified on the basis of Section 4, 5 and 5 of the International Agreements Act, because the domestic law and the treaty law actually are one and the same in Australia, or have to be read together in Australia. And therefore, so this section within the domestic law will have the same effect as it has in the as it will have in the DTAs. So So with this, I will be finishing on the topic of source of income article. So if you have any questions on source of income articles, I would like to take it, or otherwise I will move on to the next part of the discussion, which is sword and shield analogy.
I didn't see any questions.
Okay. So next we will be discussing is on sword and shield analogy. So what is this sword and shield? I briefly discussed on the commissioner's view in TR 2001/13, wherein the commissioner says, some effect of the Australian DTAs will have a sword-like effect because of the source of income article. And by sword and shield, they just mean that, if it's a shield, all it does is just provides a relieving, alleviate double taxation. And if it's going to be a sword, if it's going to create additional rights to tax rather than what is available already under the domestic law. So let us now deep dive into the sword and shield analogy that I briefly discussed before. So this case, the Commissioner of Taxation versus SNF Australia Pty Limited, it's a transfer pricing case, and it's kind of different to what the topic is all about. But I felt I need to discuss this case because of the Commissioner's interesting argument on Article 13 and the domestic transfer pricing provisions, which actually led to a series of further amendments in the Australian transfer pricing rules. So the facts are just simple. SNF Australia Pty Limited was a member of a global group who is headquartered in France. They bought certain chemicals from the group companies and they sold it to unrelated end users in various industries in Australia. As usual, the commissioner argued that the taxpayer has actually has overpaid substantially for the chemicals, and these determinations were made under Division 13 of Part 3 of the Income Tax Assessment Act 1936 to adjust the consideration the company received. So Division 13 of Part 3 of the Income Tax Act 1936 is nothing but the earlier transfer pricing provisions that was existing in Australia. Right now, the transfer pricing provisions have been amended and it is now part of the 1997 Act. So we are dealing with the provisions which was existing before the current provision. So just and the interesting argument the commissioner made during the course of this this litigation was that the commissioner has separate right to actually issue amended assessment as per Article 9 of the DTA. That is, the company had purchased chemicals from overseas company in France, China, and France, China, and US. And as per all the DTAs, the commissioner argued that Article 9 of those France, China, and US DTAs, the commissioner has a separate right to issue amended assessment independent of the Division 13 of the ITAA 1936. And Division 13 is again the domestic tax law provisions. So Article 9, for example, the Article 9 of Australia-France DTAA read as where an enterprise of a contracting state participates directly or indirectly in the management, control, or capital of an enterprise of the other contracting state, or the same persons participate directly or indirectly in the management, control, or capital of an enterprise of a contracting state and an enterprise of the other contracting state. And in either case, condition exists between the two enterprises in their commercial or financial relations, which differ from those which may be expected between independent enterprises dealing wholly independently with one another. So basically, this is usual Article 9, and the commissioner the commissioner argues that there is amended assessment which can be raised separate from that of the domestic law provisions, solely for the reason that, as you can see, the wording of Article 9 is very wide, and the commissioner will be capable of raising amended assessments as per Article 9, which he would not be otherwise be able to raise it under Division 13 of the Income Tax Assessment Act 1936. I hope I'm clear, but if you have any questions, Sudarshan, do you want me to explain it once again?
Clear to me, but if you can maybe encapsulate, summarize again, it will be helpful.
Yeah, so the interesting aspect in this Commissioner of Taxation versus SNF Australia is basically the argument of the Commissioner that Article 9 of the DTA, which is the Associated Enterprise Article, gives him a separate independent right to issue amended assessment, independent of the Division 13 of the ITA 1936. That is, taking for example in India, so the commissioner has a right to issue amended assessment only as per the domestic law, and we have a set of administrative provisions within the law based on which the commissioner can issue amended assessment. And it isn't, and the raising amended assessment from the DTA does not apply, because in India, as we have seen, it is the provision which is more beneficial that will apply. But here the commissioner is arguing that as per DTA also he will be able to issue an amended assessment, and as per Division 13 of the ITAA 1936 also he should be able to issue an amended assessment. And the sole reason why the commissioner is arguing this way is because Division 13 is kind of in a restricted way, whereas the way Associated Enterprises article is worded, it's very wide, and the commissioner will be able to bring in a lot of entities or a lot of companies within the ambit of transfer pricing rules, if he has the authority to raise amended assessments as per Article 9. Unless there are any questions, I will move on to the next slide. So in this case, the full federal court held that Division 13 of Part 3 should be interpreted consistently with the Schedules of International Tax Agreements Act. And as we have seen before, the court went on to further say that if the international agreement is going to remain separately, then it is going to fulfill the international obligations of Australia. But if it is implemented into the domestic law legislation, then it has to be read consistently, and therefore it is only under Division 13 that you will be that the commissioner will be able to issue amended assessment, and not independently under Article 9 as well. And the court held in favor of the taxpayer on the Division 13 ground because the price is paid were actually in arm's length. The same argument commissioner raised once again in Chevron Australia Holdings Limited as PTY Limited as well. And in this case, again, this particular argument of the commissioner was rejected. So this SNF Australia case is of 2011. Subsequently, the Australian government came up with new set of transfer pricing rules post the SNF case, only to implement the long-held view of the commissioner to say that they have independent rights from independent rights to issue amended assessment as per Article 9 and Division 13. And in this case, when they implemented the new transfer pricing rules, that is subdivision 815A in the 1997 Act, they further went on to analyze the sword and shield analogy, and they observed that I'm going to again concentrate only on the texts in green. There is no legal basis to support the proposition that a power to make or amend an assessment based on the provisions of a tax treaty can operate in an exclusively relieving manner. The special source articles Australia includes in its tax treaties are a clear example of how treaties can have the effect of increasing Australian source taxation. Further, other jurisdictions do not always apply tax treaties in an exclusively relieving manner. France appears similarly to extend its transfer pricing rules to the treaty limits. The Netherlands and Italy have applied their tax treaties in other areas with the effect of extending domestic taxation. So all I wanted to, the point I want to make here is the Australian authorities are well aware of what is happening in the other jurisdiction, and they justify their action by saying that the treaties are always not considered as one which is interpreted in a shield fashion, that is to relieve double taxation, but it can also be used as a sword, that is to create further source taxation. And this is not something which Australia alone does, but this is also something which exists in France, Italy, and Netherlands. I'll pause for a minute. If you have any questions, I'm happy to take.
Basically, the one question is actually on the deemed source. Krishnan asked, what if there's a conflict between domestic law and the treaty, which I think you previously also alluded upon. I think you mentioned that the international agreement will override the act, which means the treaty will override the act, so to speak.
Yeah.
And yes, obviously, he has made a comment as well that this appears largely to be a treaty override.
Yeah, and see, the main reason why I wanted to show on the anti-avoidance provisions and other thing is basically, as I said previously, Australia is definitely very aggressive when it comes to protecting its tax base. And from the commissioner's view, from the explanatory memorandum to the transfer pricing provisions, all I can see is they just want to justify how what they're doing is right, and all they're doing is to protect their own taxation system.
Just a quick thought, since China treaty does not specifically have there been I couldn't find it on the Satyam judgment. Of course, I think the SLP has been dismissed by the High Court, but could there be a claim of non-discrimination possible, Sumitha?
No, see, the problem when it comes to Australia is Satyam is the only landmark decision on the source of income article in Australia. And the reason is most of the cases are settled through, settlement discussions. So very few cases come to, to the level of court. And the claim of discrimination cannot arise here because see, if the China treaty is going to subject to subject of a dispute now, then 764.10 will actually apply to their case, and they will say still, as per the domestic law as well, we have the right to deem certain income to have source in Australia, and therefore, still it is taxable in Australia. That's the main.
But there is no sourcing rule, right, under the Australia-China treaty. So I'm just because Australia follows the strict dualism, and that's where it makes it very complicated and interesting.
Yeah, that's what I pointed out to 764. Like, I'll just say, so even though they do not have, even though there is no source of income article rule in China DTA, now that Australia has implemented 764.10, they are going to say as per 764.10, there is a deemed source provision already.
Got it.
So because the treaty and the act are going to be read one-on-one, like they're going to be hand in hand. So you cannot differentiate between what is there in the DTA and what is there now in the domestic law provision. And see, again, there is discrimination point Australia will not accept in this case because the reason is here when it came to, Satyam Computers case, it was a case, if source of income article was not applicable, I think it would have, given rise to it would have given rise to, the income not being taxed both in Australia and India. So it would have resulted in double non-taxation. So all that Australia was trying to do by the source of article, when there is a double taxation, obviously there's credit and exemption provisions. But in the case of double non-taxation, which is also one of the preliminary reason why DTAs are in place, I think source of income article is not actually discriminating. It is only encouraging people to follow proper measures.
Okay, so one other point on that specific legislation you brought up, which again Krishna has raised, is the source income room, at least from an India treaty standpoint, that case appears to be retrospective. So I believe this is applicable prospectively to China, the 76410. Is that the case, or again going back? No, when China treaty was entered, from that day, can the Australian authorities go back, do retroactive?
No, I think, yeah, as we all know, if it is retrospective, it has to be explicit. So in this case, I don't think it is retrospectively applicable. And if when we argue on the tax discrimination point, I think they will come back to saying, okay, in case of India, it was just, a taxation, double non-taxation situation. So there is no case of tax discrimination here.
One.
Sorry.
Oh, okay. Sorry, I didn't see Prasanna's hand. Prasanna,
yeah.
go ahead. You're on mute. There's one more question. I'm not sure, not directly related to tax, maybe way ahead for the India-Australia, probably. I believe that's what your last agenda. The question is, what are the chances of a newly registered CPA Australia through the mutually recognized MRA for Australian market? I'm not sure that's part of, I know you are not a CPA as well. So if you want, you can take it. But probably, maybe if I can jump into it, I know it's very interesting to see how the India-Australia free trade agreement on services will look into it, because one of the issues that we always seen in GATS has been the regulatory mechanisms. For example, can I, an advocate in India, can I do mediation in Australia? With mediation being going popularly, this is something which we have pondered a lot about arbitration. Because, for example, mediation, there's no need for me to be a lawyer in Australia or solicitor registered in Australia. So by virtue of the India-Australia free trade agreement, can I go ahead, do mediation without any regulatory enforcement regime? It'll be very interesting to watch. I don't have an answer. We need to look at the final negotiated agreement, but I think that's largely related to that.
Yeah, I don't know. I don't want to promise on something which I don't know. So yeah, I'm sure there are regulations, but I don't know how reciprocal promises work. So yeah, I think we should wait and see on that. Yeah. So finally, we are going to deal with the Satyam Computers decision. So I'm sure everybody would be well aware of the facts in this case. So Tech Mahindra, which is formerly Satyam Computers, is a company resident in India and registered in Australia. In financial year 2008, Satyam had offices in Sydney and Melbourne, through which it provided software products and information technology services. These services were provided partly by employees in Australia and India, and it is accepted that Satyam had permanent establishment in Australia. The only issue was whether the payment which the Australian customers paid to the Indian company Tech Mahindra, which is treated as royalty for the purposes of Article 12 of the India-Australia DTAA. The royalty definition was very wide under the India-Australia DTAA, whereas the definition of royalty under the domestic law provision was narrow, and it did not cover the compensation that received that the Tech Mahindra received, and therefore the question was whether Australia could still tax it. And as we discussed at length now, I'm sure you'll all be able to appreciate why or how source of income article played a role in the Australia DTA interpretation in this case. And because of Article 23 of the Australia India DTA, which I also showed previously as an example of the source of income article. And because of taking into consideration Section 4, Section 5 of the International Agreements Act, the judgment was that Australia has the right to tax that particular arrangement. And as I said previously, this does not result even if it resulted in double taxation, the Indian authorities would have provided credit or exemption for the tax that was paid in Australia. And this does not result in any sort of discrimination here, because it was a situation of double non-taxation, and Australia having the right to tax that particular arrangement, only because it was not covered under the domestic law provision. Quoting the source of income article rule, they said, because DTAA taxes that particular transaction, even as per the domestic law, it is deemed to have a source in domestic law, and therefore it is taxable. And on 20th March 2019, the High Court of Australia rejected an application for special leave on the reason that there is no there is no reason to doubt the correctness of the full federal court decision, and that was all the High Court said. And yeah, going by that, this is now the rule of law when it comes to source of income article in Australia. And I don't want to go into detail on Satyam Computers, because I'm sure everybody is aware of that particular decision. So I'm happy to leave it at here, or if you want me to deal with it in detail, I'm happy to do it.
Good, Sumitha. You can then move on. Running short of time.
Yeah. So the next thing I just want to, this is nothing very spectacular, but just wanted to point out what was the intention when the India-Australia DTA was implemented into the International Tax Agreements Act 1953. And the government's view has been the article is also designed to ensure that where an item of income, profits, or gain is taxable under the agreement by both countries, double taxation relief will be given by the country of residence of the recipient of the income, profits, or gains in respect of tax levied by the other country in accordance with the taxing rates allocated to it under the agreement. To this end, the article effectively provides for income, profits, or gains derived by a resident of Australia, which is taxable by India under the agreement, to be treated as foreign income for the purposes of the foreign tax credit provisions of the ITAA. So basically, it just gives an understanding of why Article 20, what is the real purpose, or the intention behind Article 23. And it just ensures that the jurisdictional source right of each country to exercise the taxing right is allocated to it by the agreement over residents of the other country. So if there are no questions, I would like to move on to the next topic on our agenda, which is reasons for inconsistencies and solution.
Yes, please.
Okay. So Justice Jennifer Davis, the judge of the Federal Court of Australia, in a paper, Tax Stability, dated 29th October 2019, has recognized the reasons for inconsistencies, and she's attempted to provide what she thinks is the solution, which will help in the courts to determine or to interpret the treaties in a consistent fashion. And that is the first one. The first inconsistency that she recognizes is unilateral international tax measures, which is Australia is is well known for. So the example here is subdivision 832J, which I spoke about, the targeted integrity rule. This rule is not part of BEPS Action Plan 2, but this is something which Australia has invented on its own. And so the problem is, if somebody is not aware of such unilateral measures, again, it's going to be a problem. And there is no tax transparency here. I know Australia would want to achieve tax transparency, and that is why they have accepted CBC reporting and all the exchange of rulings and other things. But when it comes to such unilateral measures, I think the tax transparency is lacking, and which is going to be a problem if for all the global companies, because they have to, such rules such as the hybrid mismatch rule, which will involve rules of so many other countries involved within the group. I think it's going to be a cumbersome process or a compliance process for the global entities to follow each and every measure which are unilaterally introduced into the domestic law. When it comes to treaty interpretation, she recognizes the lack of uniformity in construction of tax treaties, which we know from the example of source of income article and the other examples which I gave on Article 9 versus Division 13 of the ITA in 1936. So we understand there has been a lack of uniformity. And the other thing is each country has their own version of treaty interpretation, like how India thinks it has to be, the domestic law has to apply only when if it is more beneficial to the assessee. And so when I joined the international tax team, all I used to think was, so whenever there is an international tax issue in India, all I would do is just go to the relevant double taxation avoidance agreement and see what the agreement says, and only then come to the domestic law. Whereas in the case of Australia, it's quite different. We have to first look into the domestic law, and only as a secondary supplementary measure, DTAs are applied. And that's why I feel there is a lack of, I do accept her point on lack of uniformity in construction of treaties. And other interesting aspect is, she mentions regard must be given to foreign case law. And there was an anecdote in her paper that in case of Tech Mahindra case, when the case was initially before Justice Perry in the Federal Court of Australia, they are referred to Asadi Pacho Andolan, Kulandangan Chettiar, and all those other cases. But there was this one Supreme Court case which they wanted to rely on, but they were not aware of at the time when the decision was in the federal court. But when they took the case before the High Court refused to entertain that particular case law. And I think this is one good reason as well to rely on foreign case law, because see, common law countries, I think we can rely on each other's cases. The principles are same, just that the way we interpret and the domestic law provisions vary a little. But when we actually give importance to foreign case laws, I think that can improve uniformity as well. And yeah, the third point with respect to treaty interpretation is difference in language of tax treaties and domestic legislation. Yeah, this is a well-known problem. There are some definitions like permanent establishments and other things which are very yeah, the contrast now I'm thinking of when I'm saying this point is, I think in India, the permanent establishment definition is quite wider in the domestic act, whereas in the DTA, it's kind of narrow. But I think it's the other way around in Australia. In the Australian domestic law, it's kind of narrow, and the DTA is kind of wider. And that is the reason why Australia wants to use source of income article to actually deem the source of income in the Australia as per their domestic law provisions. So I think that's an interesting comparison between the legislations of India and Australia. And the third point is integration of soft law into domestic law. By soft law, she means the OECD Model Convention or the 2010 Transfer Pricing Guidelines, and all the other supplementary means of interpretation that we use in international tax law practice. So Australia has taken this into effect, though not in any other sector, but at least in transfer pricing. As I mentioned before, there is Section 815.22 of the ITAA 1997, which says that the documents covered by this section includes the Model Tax Convention on Income and Capital, and also the Transfer Pricing Guidelines 2010. So this will bring some sort of smoothness in the interpretation, and it's easy for the court to also, rather than saying the OECD model convention and the transfer pricing guidelines are a supplementary means of interpretation, now that it is part of the domestic law, it will have even more sanctity than it was previously used as a supplementary means of interpretation. And the last thing is foreign tax law as an integer for domestic law. And I think by the way the base erosion profit shifting program is going, an international tax professional can just not be territorial anymore. So if I practice in Australia, I cannot say, okay, I know Australian tax law and international tax aspects of Australia well, so that is enough for me to practice in Australia. But that is not the case anymore, because with hybrid and mismatch rules, so when we have to understand whether the payment that is made by an Australian entity to an US entity, whether it is included or whether there is a deduction, we have to understand so many other aspects of US tax law, saying whether it is a disregarded entity as per US tax law purposes, whether it is a transparent flow through entity as per US law purposes. All those things are necessary for us to understand for implementing the hybrid mismatch rules in Australia. So I think the foreign tax law as an integer is also playing role in the inconsistencies here. If there are no questions, can I move on to the next slide?
Yes, Sumitha.
So we have come to the end of our presentation. I would like to conclude by saying, with the increase in international relationship between India and Australia over the years, I think, as I mentioned previously, I don't think tax practitioners can anymore say, okay, I am aware of a particular country's taxation laws and that is enough. And I think we all have to know each other's tax system well to actually provide a holistic view to the client when it comes to international tax issues. And as you can see here, Australia and India has a lot of plans. They have entered into comprehensive strategic partnership agreements, and there's going to be free trade agreements between Australia and India, which they are expecting it to be signed by end of 2022. And more specifically, the latest on the India-Australia relationship is that the Australian Treasury has released a press release saying that they want to expand their treaty network and are in the process of negotiating treaties with India, Luxembourg, and Iceland as part of the first phase of the program. And I understand, as part of the negotiations with India, the main issues that they are dealing with are the source of income article and the royalty definition. But however, we have to wait and see if the new negotiations or the new treaty will make any difference to the Satyam case's interpretation or the source of income article rule. As I already mentioned, because of this section 76410, which is now included in the domestic law itself. So maybe we have to wait and see how things go with the new treaty, and I am just waiting to see how is it going to be different than the treaty that we already have. If there are no questions with this thought, I would like to conclude my presentation. And thank you, Sudarshan, for bringing me before the forum once again, and to all the moderators. And also thank you all for spending your Saturday morning with me. And I hope it was well spent. I'll keep this forum open for the next 5 minutes to take any questions you may have. Otherwise, thank you all again for your time.
Thank you very much, Sumitha, for sparing your Saturday afternoon as well. Fascinating. This is exactly what we had envisaged, the amount of intricacies that the tax treaty interpretation, which is becoming an animal in itself, and the fact that we still don't have a systemic interpretation. What I mean that you also showed VCLT slide, but then I believe the public international law interpretation and the international tax law interpretation are still at loggerheads. We don't have a systemic interpretation, and the fact that each country come with their own interpretation makes it interesting, and we're going to have more fun when we have other conventions coming in as well. Before I formally conclude, there are a couple of reflections or, from the audience side. One is, Mr. Krishnan asked whether Article 23 is unique to India, which you have answered as well. So we will also pass on the slide. There are some treaties, for example, China, specifically Article 23 is not there. Without bringing up the slide.
Yeah.
And there's a question from Amit, whether soft law interpretation by Australian tax treaty be appealed.
Appealed in the sense, like, because it's now integrated into the domestic law system, it is now considered as part. So instead of having it as a supplementary method of interpretation, they've just integrated it into the domestic law provisions, and so they are now guided by the principles in the OECD Model Convention and the TP guidelines. So there is no specific appeal with respect to the soft law interpretation.
Correct, Sumitha. There are also other reactions where, Krishna has alluded to the fact that, DTAA cannot assume the role and take basically the sword shield. So he believes that there cannot be a sword. My thought to that would be, I remember Professor Klaus-Vogel says, DTAAs act like a stencil over a tax treaty. Over the domestic law. Wherever there are holes, the domestic law will take over, and wherever there is coverage, the treaty will take over. But having said that, I also, even though Mr. Krishnan says that would be happy to wind up with your views, he says DTAA cannot assume the rule. I come from school of Professor Michael Lang, where we've had extensive debates on this, and he also believes that, there is nowhere in international law which says DTAA cannot generate tax liability. So in the sense, it cannot worsen the taxpayer, but nowhere does it say it cannot. So there can also be situations where DTAA can also act as a sword, just from a counter perspective. But,
yeah, I agree to what you're saying, Sudarshan, and the whole presentation. See, again, I completely agree with what the commissioner's view on the interpretation is, or the explanatory memorandum, as I referred to previously. They say tax law at the end of the day is within the constitutional limits of each country. So whatever the country thinks, though we are all party to the OECD forum, G20 countries, and all that, each country has its own constitutional limitations, and that is why I think it makes it, that makes international tax law very interesting. And yeah, basically, yeah, that's all I wanted to add. And yeah, you are right in saying that they can be definitely used as a sword, and there's nothing which stops them from being used as a sword. And if at all, if the other countries feel that this is how treaty has to be interpreted, then I think we should have harmonized principles on interpretation of treaties, which I don't think is going to come anytime sooner.
Some interesting conversations happening, but I'm afraid we will have to stop here, Sumitha, because way past our time. If you can just share your email ID for the participants, and if there are any specific questions where they can directly reach out to you, that would be helpful. So do you have a final deck which contains your credentials or coordinates?
No, I just have a thank you slide. So
Okay.
I can just maybe, I don't know if I have a chat function here to type it, but then yeah, or I can just say it's just my name, Sumitha, SUMITHA law for legal, LAW @gmail.com. So yeah, I'm happy to take any questions. And yeah.
All right. Thank you very much to all. It's been a very lively conversation, fascinating insights. Thank you very much, Sumitha. Quite a lot of food for thought from Australia. So
yeah.
Take care. Now that the pandemic is winding down, look forward to seeing you in Chennai, address our members physically. Until then, thank you very much to all the participants. We'll keep you posted on our next program. We're trying to cover the other parts of the world as well. So thank you very much. Have a good weekend. Take care.
Thank you all.
Closing the session here.